You're doing everything right. Index fund, automatic contributions. You even know what an expense ratio is. You feel like you're finally in the game. You are in a game, just not the one you think. There are 7 versions of Wall Street running right now. You have access to one of them, and the people on the other 6 floors benefit directly from you never finding out the building has more floors. Here's the blueprint. Marcus is 29, $67,000 a year, $400 a month into an index fund, automatic, every month without fail. He turned off his notifications so he doesn't panic sell. He has a spreadsheet. He thinks he's doing what the smart money does. He's doing what the smart money needs him to do. That's a different thing. Here's level 1. The retail investor. Public markets only. Stocks, ETFs, index funds. Marcus has access to all of it, and it's genuinely good. A low-cost index fund is one of the most honest financial instruments ever created. But it was also created to keep Marcus participating, consistently, predictably, through every downturn. That last part matters more than most people realize. When institutional money needs to exit a large equity position, it doesn't sell into a void, it sells into buying pressure. Marcus's $400 on a Monday morning, multiplied by millions of accounts doing the same thing, contributes to the aggregate buying pressure that lets a $2 billion fund exit without crashing the price on the way out. He thinks he's investing alongside institutions. He's the infrastructure they use to leave. The financial news Marcus reads every morning to make his decisions? Produced by entities that depend on the players above him for advertising revenue, data licensing, and access. The market narratives, the analyst upgrades, the now is a good time to buy cycle. The information environment is shaped upstream and arrives downstream. Marcus thinks he's reading the news. He's consuming a product whose incentives were built above his floor. The advice is often correct. It's also extremely convenient for the people who need him to follow it.
Level 2. The mass affluent. Now meet David. He makes $210,000 a year. He has an advisor, quarterly reports, someone who calls him by name. Level 2 feels like a promotion from Level 1. The math says something different. $300,000 portfolio, 1% advisory fee. Average fund expense ratio of 0.5%. That's $4,500 a year in friction, before the market moves a single dollar. Over 20 years, compounded at 7%, that fee drag costs approximately $280,000. Not from bad advice, from the cost of the relationship itself. Most people at this level have never run that number. Run it. Here's what most people miss about Level 2. The advisor relationship isn't just about returns. It's about behavior management. A retail investor who stays invested during a crash is worth far more to the upper floors than one who exits. The entire financial wellness industry, the apps, the media, the quarterly calls, the stay-the-course conversations, exists to keep people at Level 1 engaged through volatility. The advice is good. It's also the single most valuable behavior the upper floors need from the lower ones. David has no idea what's about to happen to his understanding of the system. Before Level 3, you need to see something first. It's 1999. Your neighbor, not a finance person, an HVAC installer, is talking about his .com portfolio at a backyard barbecue. He's made $40,000 on paper in 8 months. CNBC is on in the background. The narrative everywhere is, get in now. This time is different. What he doesn't know is that the venture capital firms and institutional investors who funded these companies had already been reducing their exposure for months. Their lockup periods ended. Their shares hit the public market. Retail buying pressure absorbed the exit. By March 2000, the early institutional money is already out. The HVAC installer loses 60% in 8 months. No law was broken, no conspiracy. It was the architecture working exactly as designed. The people on the upper floors had information, timing, and exit mechanisms the lower floors didn't have access to. The HVAC installer learned the wrong lesson. He thought, markets are risky. The real lesson? Not everyone is playing the same game. And the people who designed the game knew it was ending before he did. That asymmetry wasn't created after 2000. It was already written into law. Since 1982, the SEC has maintained a document called Regulation D with 2 specific thresholds that almost nobody outside the upper floors knows to look for. Here's the first one.
Level 3, the accredited investor. David is at a dinner party. Someone mentions a private placement, early access to a real estate fund, institutional-grade return profile, not available on any brokerage app. David asks how to get in. 4 words. Are you accredited? He goes home, searches the term. SEC definition. $200,000 in individual income or $1 million in net worth excluding primary residence. He checks his numbers. He qualifies. He is qualified for 3 years. Nobody told him. No letter, no notification, no ceremony. The door existed. He just didn't know to look for it. Above that line, hedge funds, private placements, venture capital, private REITs. Products with historically different return profiles than anything available on a public exchange. Below it, only what Marcus has, by law, published by the SEC, in plain language, since 1982. That nobody told you to read. Approximately 13% of U.S. households currently qualify. The other 87%, including people earning $150,000 a year, are legally restricted from these products. The legal rationale is investor protection. Sophisticated investors can evaluate complex risk. The practical effect is that the products with the most attractive historical return profiles are legally restricted to people already wealthy enough to survive losing them. The gate isn't protecting you from risk. It's protecting the return profile of the people already inside. And the capital flowing through this level shapes what eventually becomes public. The startup Marcus buys on IPO day was priced and partially exited by accredited investors before he ever saw the ticker. The IPO is not the beginning of the opportunity. For level 3 and above, it's closer to the exit. David thinks he's found the top floor. He hasn't. He's found the second one. Level 4. The qualified purchaser. There is a second SEC designation above accredited investor. Almost nobody knows it exists. Qualified purchaser. $5 million in investable assets, not net worth. Investable assets. Above this line sit fund structures and private vehicles that accredited investors still cannot legally enter. David has $800,000. He is years away from this line. He just discovered the first legal gate and immediately learned there's a second one directly above his head. The velvet rope doesn't disappear when you reach it. It moves. The strategies running inside these funds, quantitative momentum, long-short equity, statistical arbitrage, directly shape the price movements Marcus sees as the market. When a major fund at this level rebalances, the pressure moves through public markets immediately. Marcus experiences it as volatility.
To the people behind this gate, it's a scheduled portfolio event. Same movement, completely different relationship to it.
Level 5. Institutional capital. This is where the psychology fully inverts. Yale's endowment doesn't apply to hedge funds. Hedge funds court Yale. They offer reduced fees, sometimes zero on co-investments, because Yale's participation signals legitimacy to every other investor in the room. Yale negotiates different share classes. Yale has its own research team. Yale's alternatives allocation has historically sat above 70% in assets Marcus cannot legally purchase. Marcus pays full retail for the market. Yale pays wholesale. Same market, completely different price, completely different terms, completely different risk profile. They are not playing different versions of the same game. They are playing different games that happen to share a name. When pension funds rotate out of a sector, when institutional capital decides technology or energy or real estate is no longer where it wants to be, that movement reshapes the entire landscape that eventually reaches public markets. The sectors rising and falling on Marcus's app are rising and falling partly because Level 5 entities decided 6 to 18 months ago. He's watching the downstream effect of upstream decisions and calling it the market.
Level 6. The Allocators. At this level, the entity's presence in a deal is itself a financial product. Norway's government pension fund Global owns approximately 1.5% of all listed global equities. When it moves, the market doesn't react to it. The market absorbs it as a signal that reshapes how every level below prices the same assets. These entities don't accept terms, they architect them. They are sometimes invited into deals before the structure even exists, not as investors, but as co-designers. This is no longer money seeking returns. This is money functioning as geopolitical infrastructure. Level 6 entities hold significant positions across the financial ecosystem: asset managers, exchanges, data providers, media conglomerates, infrastructure businesses. The information environment Marcus uses to make decisions is an asset class partially owned by the people whose decisions he's trying to track. He's using their product to understand their behavior. The map was drawn by the territory.
Level 7. The infrastructure layer. This is the boss level, and it's different from everything above it. Every other level invests. Level 7 owns the pipes every other level depends on. Prime brokers lend the shares short sellers borrow, collecting interest whether the short works or not. Market makers profit on the spread of every trade that crosses their infrastructure, including Marcus's $400 monthly contribution. The bank collects fees whether the M&A deal closes or collapses, whether the IPO prices or pulls, whether the fund returns 30% or blows up. Then January 2021 arrives and proves everything in 1 week. GameStop. Retail investors on Reddit think they're beating Wall Street. They're not wrong. They squeezed several hedge funds into billions in losses. But Citadel Securities, a market maker, processed both sides of every single trade. Reddit buying, hedge funds covering shorts, panic sells, FOMO buys. Every transaction crossed their infrastructure. By one estimate, $850 million in 1 week. Not by betting correctly, not by timing the market, by owning the pipes that every bet flows through, regardless of direction. Hedge funds lost billions. Retail traders made and lost millions. Citadel Securities collected the spread, both sides, every time. And it doesn't only happen during market events. It happens every single time Marcus opens his brokerage app. His trades are free, no commission. They're free because Citadel Securities pays platforms for the right to execute them. Why? So they can process the order and earn the spread. Marcus isn't the customer. He's the product. Payment for order flow. 4 words that prove Level 7 doesn't need a market event to monetize Level 1. It happens on a Tuesday morning, when nothing is happening, and Marcus buys $400 of VOO. Level 7 doesn't care about direction. It cares about volume. Every trade, every direction, every level, forever. Marcus's panic sell in a downturn isn't a mistake the system regrets. It's a transaction the system processes and charges for on the way down. Go back to Marcus one more time. He's not just on a different floor. He's playing on a board designed, monitored, and monetized by the people who built the building. His participation isn't incidental to the system. It's load-bearing. So here's what changes now. First, name your floor honestly. If your entire investable portfolio is in public market instruments, you're on Level 1. Not Level 2 because you have an advisor. Level 1 with a Level 2 fee structure sitting on top. Name it. You cannot navigate a building you won't admit you're in. Second, run your fee drag number today. Advisory fee plus average expense ratio multiplied by your portfolio value, compounded over 20 years at your expected return. Most people at Level 2 have never done this. Run it. Then decide if the relationship is worth the number you get. Third, look up the SEC Accredited Investor definition tonight. Not to immediately change anything, to know where the first legal threshold sits relative to where you are right now. If you're within 5 years of qualifying, that changes what you should be optimizing toward. And you now know there's a second threshold above that one too. Fourth, change how you consume financial media. Every piece of financial news you read was produced by, distributed through, or financially benefits entities operating above Level 3. That doesn't make it wrong. It makes it a product with a perspective and an incentive built in. Read it as what it is. Fifth, understand that staying invested through volatility is correct behavior, and also the behavior the upper levels structurally need from you. Both are simultaneously true. Knowing this doesn't change what you should do. It changes how clearly you see the system you're doing it inside. Marcus is still on Level 1. The $400 is still going in. That hasn't changed. And it shouldn't. But something fundamental has shifted. He's not optimizing a strategy anymore. He's navigating a system. He knows what floor he's on. He knows what GameStop proved and what payment for order flow proves every single Tuesday morning. Level 7 doesn't need him to be right or wrong. It just needs him to trade. In a system built on your emotional reactions, the most valuable thing you can be is informed. Not rich, not accredited. Just clear-eyed about the game you're in. Wall Street isn't a market, it's a building with 7 floors. You were handed a key to one of them and told it was the whole building. Every floor above you has a view of your floor that you don't have of theirs. Now you know the building exists. That's not nothing. That's where it starts. Drop a comment. Which level did you already know about? And which one changed how you see something you thought you understood? And if you want more of the blueprints behind how money and power actually move, subscribe. This channel is the blueprints, not the brochure.